Hey everyone, Douglas here, and welcome back to the MMT Macro Trader. It's macro update time for Wednesday, November 1st, 2023, 10:47 a.m. Eastern Time. As we get things rolling for today's update, apologize about the delay in getting this posted, but we are back behind the mic and ready to roll. All right, listen, admittedly, last week, the week prior, a little more selling than we had anticipated, but we stuck with it. It looked like that we weren't missing anything, that the flows would eventually kick in here. And since the end of last week, we've seen a very strong rally, 3% from a little over 3% now from the lows that we printed on Friday. And it looks like the reversal might just be in. Like I said, each step of the way to this point, it has been of strength through some overhead resistance, and we are starting to we're starting to see those flows finally kick in and carry this market higher through that kind of brief, slightly more than anticipated window of volatility to finish off the month of October. I still think from here we rally. In terms of the volatility, though, we're not entirely in the clear yet. We do have the later today, as I'm recording this, we will have the Fed rate announcement. Actually, I can go ahead and bring up the Fed Watch tool, which at this point is anticipating no change in the rates that the Fed's going to come out and leave rates where they are at. What is more important to markets during this time period is less about what at least in the immediacy, right? The implication on kind of the volatility in the short run is less about where the Fed sets the rates. That has longer term implications, obviously, but it's really going to be, what do they say in their initial statement? How do they view inflation? What is said in the press conference following, and then ultimately how do markets interpret that, and then the longer term effects and how do they position themselves. That entire process plays out over the next few hours following the rate announcement, which is in 3 hours and 10 minutes from now, and then it gets digested. Usually it takes a day and a half for all of that to really end up playing out, and then usually by, say, Friday, we're on Wednesday right now, usually by Friday we see where things settle and kind of what the longer term trajectory is going to be out of something like a Fed rate hike that is, of course, so important right now given where inflation is at, and given the fact that so many traders, investors, participants still have so much of this backwards. The ebb and flow that comes out, the reverberation that comes out of these things take a while to fully settle before the trend can get established. I think we might see a couple wild swings as we normally do. Ultimately, though, if we can remain relatively unscathed from the Fed rate hike today, we're already seeing those strong underlying flows kick in. Again, unscathed, I think we settle with a rally into the end of the November OPEX, and the next 3 weeks we just kind of rally from here. And that is what I'm expecting. Again, there's always the chance that the Fed says something very unexpected and you get some sort of hedging dynamic that plays out, and we're unable to kind of shake the negative gamma situation that we've been in for the better part of really for the better part of the last 2-3 months now, but particularly in October. But if that scenario doesn't play out, then everything is there to really shake the negative gamma situation we've seen ourselves in again for the last 2-3 months. And as that unravels, that too, not only do the structural flows, the underlying fiscal flows give support, but also the unraveling of that negative gamma position likewise will give additional upward pressure on price and be a bit of a tailwind to markets. So if this is it, if we're really able to take off here and we don't get too caught up into anything crazy that the Fed says, I think we're really set up here to rally again into the end of this year. And as we know, it's the end of the year where the flows get pretty strong. So as it stands, finally seeing the reversal that we wanted to, and today will be a big day to really finally shake us out of what still is kind of a lingering negative gamma play in the markets right now, and still a bit of a grip on the markets. With that being said, let's look at our our flagship tools here, Deep MMT. Interesting kind of progression here as we've gotten closer and closer to what it saw was going to be a big rally through November. What's interesting to me is it's still saying that we're way underpriced, which is quite clear based on the fact that we're rallying very strongly at this point. So I think it understands that we're underpriced. What is interesting to me though is as it starts to project in the future, it really starts to see things struggle from this point forward. and not seeing a new high in the manner that it was a few weeks ago, or maybe even a few months ago. Maybe that's just because the flows fell off a little bit more because of that October drain, or it just is kind of what I'm going to call pattern matching from prior time periods, and fully hasn't incorporated the reality of where we're going to be at the start of next year. Either way, I mean, the fact that the closer we get to it in time, the more likely it is to be right in its prediction, and it's starting to see that maybe we might not be running as hot as anticipated in the beginning of the year is worthy to, or is at least worthy of pointing out and noting that it is starting to see a bit of a weaker New Year run as we head into 2024. Again, I'm not going to put a ton into this until we get to that point and allow kind of the flows to kick back in here after the bit of the contraction we saw in September and October from a flow standpoint. But it is at least worth pointing out here that we're starting to see a slight decline in kind of the overall anticipation of the rally here. Still seeing us underpriced, still seeing a rally. I'm still long, anticipate being long heading into November. No change there, but it is worth noting that we are waning a little bit from the deep MMT perspective. When we look at the rest of the flows, we look at the flow phase model, still in the highest quad here. Again, relatively strong flows, bank flows far from a top of a cycle. No change at all here. And again, why I feel like we can be relatively confident that despite the kind of the recent volatility we've had, that we can continue to see things push higher from here based on the flow phase model. So again, overall flows are fairly strong, and when we look further into the data and we look at the flows themselves, we have seen the daily fiscal flow, the 90-day average, really kick up here at this juncture, and even starting to see the smooth net flow find its way to flatten out, and I would absolutely expect into the end of the year a very strong push from a fiscal side of things. And I think we ride this next wave of fiscal flows higher. So again, a little bit longer than expected on the downside and a little bit steeper than expected on the downside from the flow because of that October drain that ended up occurring. But at this point, we have reverse course, and I think we start to really see a strong surge into the end of the year for flows, and then we kind of set back into the normal cyclical nature of how flows play out. Looking at the monthly comparable table again, you'll see that October finished off with a very less than average October. In part one because of that massive flow. I mean, effectively a flat October. In part because of the massive drain from the October tax drain, but also because of the fact that the first spending day of October was the last calendar day of September this year, because the first day of October was on a weekend, so the big spending went out at the end of September, which bolstered September, but then left October lacking. And so if you look at 2019, which is a good pre-COVID corollary to how the spending cycle used to be, October is normally a good build. November is very hot, which is obviously we're now in November, which is why we're expecting things to really take off in this month. But September usually low, October building higher. This year it was reversed again, just because of the way the flows ultimately went out. Again, we're going to expect November to really start to tick up here. You can look at, and I'll upload this chart for the dashboard as well. You can look at the daily flows each individual day. We did a bit of a drain on the 30th, and then I believe 31st should be flat, but then we'll see the big November 1st build to finish off the week when that finally gets reported. Again, flows overall looking strong. Granted, CPI adjusted year-over-year surplus deficit still kind of pulling down, but this is what we were anticipating. I now expect it to kind of flatten out over time, and no real concern quite yet of a surplus in real terms by any stretch. And so again, still very healthy, and the best way to look at that is using that flow phase model. Margin debt, again, I think we looked at this last week, but still far from falling off here. If anything, everything that I'm seeing is just showing that we're really in step number one or stage number one or phase number one, maybe entering phase number two of an acceleration of the entire credit cycle. That would kind of equal the same look then as margin debt as well. We're far from the top is what I'm trying to say. We need to be concerned of massive tops building when we're peaking, not when we're coming off the bottom. And again, the same idea extrapolates to the banking sector. Taking a look at total assets here. Still starting to re-expand now year over year. So total assets starting to grow year over year, which looks good. One of my favorites to look at because it correlates so nicely with equities. Starting to see other securities again round the bend here at the bottom, fully kind of making that bottoming pattern. And again, I think within a few weeks here, we will see full acceleration. Again, correlating really nicely with risk assets as a whole, and exactly what we would expect as we start the next kind of credit cycle up. And again, it's up here when we top that we want to be concerned, right? It's not at the bottom that we need to be concerned. It's the top of the cycle that we need to be concerned at. That's when the risk is actually present. We're not there yet. Again, this shows best. I have this zoomed out in bank credit. Again, the best time to buy is when the bank credit cycle was bottoming, right? When we were pushing below zero, that's when you want to buy. The concern for recession happens before that, when the bank cycle has had quite a lot of time to run. And, to a certain extent, as we were entering 2022, we were topping at that point, and then we settled and kind of had what was a non-employment affecting recession. I mean, that's probably the best term I could coin to talk about what actually played out in 2022. It was a non-employment affecting recession. We had the bank cycle roll over. We had fiscal give way. We never really had unemployment shoot higher. Again, I think there's just still so many latent effects post-COVID to drive that off. And then we had the Fed immediately hike interest rates, which, again, as we've talked about, usually they drop rates to zero in that instance. And because of the Fed kind of doing the opposite of what they normally would have done, we had that additional interest income to bolster the fiscal flow that kind of kept things going. And again, at this point, we're at the bottom, starting to turn the corner of the overall credit cycle with still very strong fiscal growth. So again, across the board, we continue to look healthy here. Let's shift gears a little. Let me take a look at the VIX Bollinger Band real quick. We've really rejected the upper boundary, now actually below the mean line here. So things are looking good. Seeing volatility compressed again. If we can just get past today, let things settle into tomorrow. We'll see some swings today. That's normal. I think we should start to expect some really strong flows and support from kind of the vol perspective, the vol kind of that vol crush perspective, and yeah, I mean things look good here, and this is supportive of kind of the rallies that we like to get behind and track to the upside as they push. So again, just kind of good recovery across the board. Also kind of a benefit to us right now. I think when I look at sentiment here, very misaligned with where flows are at. We were kind of hoping for something like this to play out. Finally did build this way. Bullish sentiment far from way under extreme, but still below the average, and bearish sentiment quite above the average. So bearish sentiment way too high given where flows are at, and I think we have again a good couple, maybe month to 6 weeks of a rally in front of us where sentiment just is not aligned with the underlying realities of where flows are at this moment. So we're in a good shape, or we're in a good position to be a contrarian here relative to the rest of the market. So that is good. Taking a look at the economic calendar again, the rate hike 3 hours from now, and then the press conference following that. That'll be important. Also, just some big data this week as a whole. We have the Fed rate decision. We had JOLTS come out this morning, looking fine. Still showing a relatively strong labor market, so no concern there from a macro perspective. And then on Friday we have jobs data. ISM coming out this week, so a lot of important data this week, and I think if the market can digest this without needing to hedge into the future, downside hedge into the future, I think we can get ourselves out of the negative gamma rut. Strong fiscal flows, mispriced relative to sentiment. That's just setting up for a very strong rally, like I've been kind of arguing for into the end of this year. and that is certainly my bet still at this moment. Last up, I want to take a quick look at the options expiration, just to point out that November 17th is the end of options expiration, which the way to read this is if we do get a rally over the next 2.5 weeks, that could be kind of the window of opportunity for that rally to pause out. We'll need to see where we're at when we get there, but OPEX happening on the 17th. And that is where we are at. Again, the biggie is going to be the Fed rate decision this afternoon, how markets settle from there. But at this point, looking at the S&P, I think we found our bottom right at major support right around 4,200. We're back above 4,200. The next big thing is just to let that hedging dynamic kind of reverse course and let us fully get behind this market in terms of being a reinforced buyer as opposed to a reinforced seller. And I think post Fed rate decision, I think that is the possibility for that to fully switch, and then some of the data later this week maybe can just continue to support that rally going forward. So things playing out nicely. We'll let it we'll kind of let it continue to build from here, and just kind of hope that this rally can finally have some legs and everything certainly data wise pointing towards that being the reality. So with that being said, I am going to wrap things up here. Good trading, everyone, and we'll talk to you next time. Bye bye.